Hey everybody, Preston Brent here. Happy New Year. Hopefully you guys had a great holiday season. Welcome to this free edition of our Trader User Group, a weekly roundup. This is for the trading week ending January 3rd, 2020. New year, new decade. Thanks for tuning in, everybody. This week's theme is Let's Party Like It's 1999. Well, this past week, as we're kind of breaking off and coming into 2020, I keep saying 2019. So as we're moving into 2020, we saw this past week, it was a relatively stable, flat week until Friday. The Dow finished down about 4 basis points, which is essentially flat. S&P was down about 16 basis points. Russell was down about 0.5%. NASDAQ was the only winner for the week, up 16 basis points. But net, just about everything was flat. Volatility, actually, we saw a little bit of a rise in volatility with Friday's action with the U.S. killing the Iranian general there. Vol moved up a little bit, but kind of settled in as the markets came to a close during the end of the week, this past week. World markets, we saw the FTSE, which is the London market, it was down about 29 basis points, and the CAC 40, the French market, was up about 11 basis points. DAX down 88 basis points. Nikkei over in the Asian markets, Japan, it was down 76 basis points. China was up a good 2.62%. Hang Seng, which is Hong Kong, was up about 80 basis points. So the markets outside of China and maybe Hang Seng were pretty much flat for the week. And the sector performance for this week, the best performing sector besides oil, was industrials, finishing about 59 basis points to the positive, and the worst was materials, finishing down 2.49%. Just as a reminder, the trailing PE ratio for the S&P is 25.67, which is a huge number. The forward PE is 19.7. So they've discounted the forward PE ratio by about 23% from the trailing 12. And the annual S&P dividend yield is about 1.8 with the 10-year interest rate at 1.78. So that's going to continue to funnel money into the equity markets because you've got the 10-year less than the annual dividend yield. So we're going to see money continue to come in. Now, as we kick off this new year, new decade, we truly had an outstanding performance over the past decade. And it was kind of capped by 2019, which is the best performance since 2013. I mean, NASDAQ was up a little over 35%, S&P up over 28%, Russell's up 25%, Dow up over 22%. I think we saw over $7.5 trillion in new wealth created just in 2019 alone. It was making it the best in dollar terms since 2013. Of course, that's going to help consumer spending, which is about 70% of the GDP, US GDP, and it's also going to help reduce the budget deficit next year when you generally see a tag on with tax-generated additional revenue coming into the US coffers. So now, of course, everybody wants to know what's going to happen in 2020. For our members, if you're not a member, I highly encourage you to come in and join us. We had a great year last year, but then again, you could throw darts on the wall, and if you were long, you made money. But I think 2020 is going to be even a little bit more tricky. But we've been doing fairly well for quite some, well, since the group started, since I started the group in 2008. We've been doing very well every year. But this 2020 is going to be a little bit tricky. There's a lot of unknowns in the market. They're known unknowns because people know what they're going to be. They just don't know what it's going to do. And that's going to affect all asset classes depending on what happens. For example, inflation, we've got, half the group saying inflation is going to slowly edge up. We got a little bit more than half saying inflation is going to stay where it is or go even lower. Same thing with interest rates. That's going to have a big impact, not only in the Feds and what their response is. Remember, the Feds are on the sidelines right now, but it's also going to have a big response on a lot of asset classes where inflation goes, okay? But we've got a very accommodative Fed right now. 10-year interest rates, finished the week at 1.78, as I said. We've got low inflation right now. Sentiment shift was dramatic starting in Q4 of this past year when the U.S.-China trade wars started to wind down, and we're getting kind of a note from Trump in a tweet that they're going to sign a phase 1 deal on January 15th at the White House. So that tends to bump sentiment even higher. So we're going to be greeted in 2020 with some really interesting opportunities. Okay, but also understand that the markets, they're humanistic in nature because that's what who trades the markets, and algos are programmed by humans, so they're kind of driven by fear and greed. And you see the same technical patterns show up over and over and over again. So if we look at the financial markets, if you look at the markets leading up to the dot-com bubble, 98, 99 going into 2000, it's very similar to what we had here. The Feds were injecting a lot of money into the markets back then via the repo market for fear of the Y2K, with the issues with that, which never really materialized. The Feds now have injected over 400 billion of liquidity into the repo markets in the US, right, in the past 4 months or so. Amazing, right? Now, they don't want to call it QE. I call it QE, but that's what they're doing. They'll deny it. But all that liquidity injected in the markets really allows momentum stocks to take off. I mean, since this new repo action, the Feds, we've seen Apple move up over 38%. Now, we're talking a $1 trillion valuation company, folks. We're not talking a $20 stock or a $30 stock. So when you've got a stock the size of Apple moving 38% since the Fed started doing this repo about 3.5 months ago, I mean, that's amazing, right? Also, look at Microsoft. If we go back and we look at Microsoft over the past decade, Microsoft and Apple alone, just those two stocks accounted for about 8.45% of the total S&P returns for the past decade. For 2019, they attributed almost 15% of the total returns. Take those two stocks out of the US markets and our returns have been reduced by almost 15%. Now, other countries don't have the Apples, the Googles, the Amazons, the Microsofts, and that's due to the phenomenal system and process and foundation that the U.S. markets have due to what I think is really the best capitalistic market in the world to provide a seeding ground and a feeding ground for all these companies. All right, and that just feeds into all of this narrative of capitalism is the best way to go. But again, you can't fight the Feds with all this money coming into the markets now. It always works until it stops working. Okay, so right now it's party time. But we've just got to be very careful. Now, one thing that kind of brought the markets back to its senses this past Friday was a volatility pop Thursday night, I think, going into Friday morning when the U.S. took out a key Iranian military chief, Salman, and when they took him out, we saw the markets in overnight hours down dramatically, but they kind of regained their overnight or pre-market lows and then moved back up. They still closed down. Vol still moved up, but not very much. I mean, Vol managed to finish the week still at 14.02. I mean, we just haven't seen much of that, right? So, but being a little bit of a contrarian here, I do believe that, we're setting up for more volatility in 2020, clearly more so than we had in 2019. The AAII, which is the American Association of Individual Investors, their members, the average cash balance that they have now is around 14%. That's the lowest it's been in over 20 years. And by the same token, when we hit market lows in 2009, the cash balance is over 45% because you see most Americans or most humans, most people that trade the markets are always the opposite side of where they should be. Okay. They're most bearish when they should be most bullish and most bullish when they should be most bearish. So in a contrarian perspective, we've got to be careful. There's also something out there for market cycles, macro market cycles, for those of you that are into it. Typically about every 80 years, the markets have significant turning points. And that started really in 1781, 1861, 1941, and now 2021. So that would suggest in 2021 going into 2022, we got to have a significant turn in the markets or a significant turning point. So just kind of keep that as food for thought. What I've got on the screen now is a weekly chart going back to 2009 lows that we had in the S&P E-mini futures around 669, right? That was on in early March of 2009. It's an Ichimoku chart. You can see the green cloud. I mean, we've essentially been above a green cloud almost the entire track, almost for this entire decade, right? I mean, just moving all the way up. And you can see here, short of one huge move down in 2019, and then of course in 2015, 2016, and then slightly again in 2011. You know, the cloud has held up on this weekly chart. Very few red clouds on this Ichimoku. Now, I'm not going to go into details on what an Ichimoku chart is. For our members, we've got a number of sessions on it that kind of breaks it out. Now, I use a combination of Ichimoku bar charts, candlestick charts, and I also, we're going to be doing more point and figure, which is a really great way to look at measuring market moves and potential moves in the markets through our Option Masters program. But if you look at this chart here, you can see just we've been we've been above the green cloud for the entire time, right? So when I say the green cloud, that would be that right there. And you can see we had this consolidation point right here. We had a long consolidation point right here. And then we had a very wider consolidation point right here. So these instances, every time we've broken out of these consolidation points and we've moved higher. Okay, we moved up to a new consolidation point. So then the issue is, where's the next consolidation point? So you can see on the far right hand side, I took a key pivot low and a key prior pivot high off of the Q4 2018 move, and it's given us some potential points up here where we have dry powder, and I'll talk about those in just 1 minute where we can move to. And in fact, you'll probably see even some of the analysts calling some of these points here. So I think we can have a pretty good run. The other thing that I have on this chart here that I want you to pay attention to is the RSI down here. Okay, so I've got the RSI indicator on, and you can see we're definitely in an overbought. Now, this is a weekly chart, so to get overbought on weekly, you really got to be overbought. Now, look at the FOMO trade, the fear of missing out trade back going into Q4 into January 2018. Nowhere near where we are right now. This was amazing, and we had a huge pullback off of that. But we've seen a few times, right? Just a few. And this goes back, guys, over a decade and then some, where we've been over the 70 RSI. Okay. Every time we've been over the 70 RSI, we pull back just a little bit. Okay. We pull back sometimes a little bit more, sometimes not. Now, this one instance right here, we had a longer term, you can see this downdraft here. All right, that just the RSI kept making lower highs and lower highs as the market kept making higher highs and higher highs. It finally gave it up and gave us this sideways pattern leading into 2016. And it gave us a lot more volatility that year as the markets really kind of had a hard time of it. Okay. And now we've moved up. We were right here in the same situation, right in this area here. And the markets have just been blasting higher, okay? And you can see any pullback stayed above the 50 level on the RSI, okay? So now we're up at this level here. So overbought, as you've probably heard many times, doesn't mean overdone, right? We can still stay overbought for quite some time. You can see we went briefly into a red cloud condition right here. That was based on this big move here in Q4 on this weekly chart, but it was very brief. And then we moved back up, and this is kind of where we're sitting right now. Okay, so if I were to take this and let's just swing it down, I'm gonna increase the size here just 1 second, and let me just do this here real quick. Excuse me, I had to put you on mute because I had to sneeze. So like if I were to blow this up just a little bit on the screen here, hang on 1 second here. Let's just get this all set and let's blow it up a little bit here. We'll zoom in right in this area here. All right. Now you can see, as I said before, I put some fib nodes on here. All right. And I've defined for you the key levels. And I believe this level right here is where we're headed to. Okay. If you look at the definition of it, this distance right here, which defines this range that we've been in, right? Like I showed you the other ranges in 2016 and 2011. Well, now if we just tack that range on here using the fib nodes and extensions, it takes us up to 35.78. That's where I believe we're headed. Okay. Now, some things have to come together for that to happen, but that's where I do believe we're going. Now, of course, it's not going to be a straight line. We're going to have a lot of volatility that's going to be associated with some of these moves because there's still some issues out there. But we've got it's silly season with the presidential elections coming up this year. We've got more on the feds and what they're going to do. There's issues, as I said earlier on it. Will there be more inflation or will there not be? How will the Fed stance be? What happens if they reduce some of the money they're injected to in the repo market? All of these things can weigh on this. But remember, markets always climb a wall of worry. Okay. With the markets a little bit kind of at ease, I think we're more susceptible to a down move than an up move near term. But I do believe this is where we're headed, guys. Everything lines up for the markets to go that way. Okay. It may seem a little bit surreal at this point in time, but 3578, call it roughly 3600, is where we can go. Right now, for those of you that are members of our group, you know we religiously follow price action because that really, at the end of the day, is who gets the trophy at the end of the race, right? I don't care where you were at the beginning of the race, how you started the race, where you were in the middle of the race, it's where you finish. And price action is where the markets basically say this is what we think, right or wrong. And keep in mind, the markets are based on sentiment, fear, and greed, and irrational movements. That's the nature of the markets. Longer term rationality comes in and fair value is found, but short term, and you can define short term as up to a year, okay, or even longer, depending on your scale. But markets can stay irrational a lot longer than you can stay solvent. So I am not going to sit here and say, okay, we're going to pull back, and then just stay out of markets for fear that we pull back and then miss out on some of the runs that we have. Some people do that, or some financial folks do that, or at least they talk about it with these TV talking heads, and that's just, to me, boneheaded move personally. But looking at this on a weekly chart, you can see how it looks right now. If I drive it down to a daily chart, you're going to be able to see that we're a little bit closer to the cloud. But again, the cloud is moving up, which is a very bullish sign. You can see we hit this 1.5 fib node, 3264, almost to the penny. Okay, the highs in the market, or the all-time highs in the market, are 3263.50 on the E-minis, and we came up to 3264.14. So just within a point. And then we're bouncing down, and we're going to chop around in this area here. I told our members that I would not be surprised to see the markets come down and test the 3100 or the 3200 fairly easily, and it can do that. All right, but we have not had. We got a bullish signal back about the second week in October on the Ishimoku to stay long. And hopefully, if you guys are not in our group, but that's kind of what you did. If you look at the RSI, you can see there is no divergence in the RSI. If we look at the MACD, there's no divergence in the MACD either. That suggests money's been coming in. I believe some of this money is also new money. It's coming in off the sidelines. Remember, there's been a lot of people that haven't participated in the rally in the markets over the past few years. All right. And they've just kind of sat on the sidelines. And this move higher is forcing money to come in, but usually that money is not smart money. Smart money is in earlier. And you guys, if you're following us in our group, we get you in earlier. We get you in with the smart money. But dumb money comes in towards the end of a bull market. Now, that's not to say that if you come in, if you're not in, you shouldn't get in long. I'm saying that I would look for some triggers to go long because, as I said, we can still run up another few hundred points, 8 to 10%, or 8%, 5%, taking us up over 3,500. But you've just got to be careful. All right. Now, if I put this on a 240-minute chart, it's a little bit of an intraday. I like 240 minutes. It's close to a day, but it gives us a little bit more quicker signals. You can see the cloud again also provides support to the markets, and it supported us right here. We're inside the cloud. Should we break this cloud, then we're going down. We're probably going to come down to this 1.38 fib node around the 3190, which means we're going to come down and test the 3200 area. Okay. And you can see on the 3200 area, I mean, we almost just sat here. This is a 240-minute chart, but that'll break down to, almost a day per each bar, not quite. But you can see that time that we spent there, right? I mean, we spent time there gaining energy until we broke out. just like that. And you can see on the MACDs, this MACD is kind of running like that. So that does suggest the odds favor breaking the cloud, coming down and testing this area here. In fact, I would like to see it personally. Let's just get some of this overbought nature of the markets off the table. Let's settle in a little bit, and then allow money, fresh new money, to come back into the markets. Okay, so that's kind of what I'm seeing on these charts here. All right. Now, if I bring you over, let me just switch the screen here. Let's see here. How do I want to do this? Here we go, right here. Let's just bring you over to another view of a different screen. I'm going to bring you over to right here. I'm going to bring you over to let's see here, like this. Let's take a look at volatility right here. Okay, so if we take a look at volatility, we're down in zone 1, which is a lower end of vol. So that means vol typically in zone 1, the odds favor it to either stay stagnant there or move higher. And you can see we've moved up just a little bit. And this is a weekly chart, but let's put it on a daily chart here. So you can see with vol, we moved up. We moved into the yellow just barely with this news of the Iranian general. We moved up just over 16, but you can see we closed well off the highs as the markets kind of digested the news and just kind of settled back in again. I remind you when Iran launched the cruise missiles against the refineries in Saudi Arabia, although Iran would say they didn't do it. They're the only ones over there that had the technology to do that. We saw crude just really bound higher, and then things settle right back in again fairly quickly. There'll probably be a little bit of a risk premium in the markets, especially the energy markets. We'll take a look at in a minute, just because we don't know what Iran's going to do. But anyway, you can see here vol is back down, moved up just a little bit. I would still consider, as I said in my opening here, let's take a look at some hedging. Members, we'll go through some of that this Sunday evening. But that's kind of looking at vol. If we look at the front month vol skew, you can see here we're in the green. All right, so we're not in a backwardation. We did move into a backwardation briefly on Friday. We've been edging up slowly. Really, we've been edging up slowly for quite some time. But you can see here we're not in a backwardation. And if we look at the back month vol skew right here, you can see here we're well into a contango skew, which is the way we want it to be. There is no fear out in the markets going out through January, February timeframe. For now, that can change, but right now the markets are just not pricing in any of that, right? And then, of course, if we take a look at the Russell futures, the Russell futures had the breakout moment. All right, we're at, and I'm going to change these over shortly. To reflect the new years and where we are. But you could see the Russell had a breakout. If I put it on a weekly chart, you can see this breakout with the rut. Okay, we've been in this mode for quite some time, and I had our members looking at going long as soon as we broke out of that level right there. All right, we've been in this very long, tight range. This was an anomaly going back to 2019, which I blame Boom Boom Powell on. 100%, right? Total miscalculation by the Feds. So this is really, in my mind, the true range right here. Because out in December 3rd, they came out and said quantitative tightenings on autopilot, and we see 2 rate hikes for 2019. And the markets didn't like that. And then sure enough, we had this huge sell-off, turning the Russell into a cyclical bear market. And then it came right back up again in January, right, early January, when Boom Boom Powell came right out and said, my bad, interest rates are where they're going to be. We're going to stop quantitative tightening. He did a 180-degree reversal. And then we've been stuck in this wide range. We just broke out of this range right here. And typically, you look at the measuring objective and then you plot that up here like this, it takes us out to brand new all-time highs in the rut as well. Okay, so that's kind of what I'm seeing here. Now, if we pull back into this range again, then all of that's off. But I don't see that at this point in time, guys. I don't see it happening. But if it does, we respect price action. We got to do what we got to do. Okay. Now, if we look at NASDAQ, NASDAQ did hit 2020 highs and all-time highs this past week. And if we look at it, NASDAQ was the only index that actually made finished in the green for the week. Okay, so if we look at NASDAQ, I mean the high. Let me just, I got to update that. I got to update all these guys because I just, markets were just moving like crazy. So there's the high for NASDAQ, 8907.25 right there. Okay, I mean, it's just a rocket ship. There is no divergence here, guys. So any dip is going to be bought. Now, I define a dip as anything between 0 and 5%. A pullback is a little bit more. A pullback is 5 to 10%. 10% to 20 is a correction. Over 20 is a bear market. So if we look at this, I see dips coming for these markets. But again, I don't see any divergences, so that would suggest that we can go higher. We suggest buyers are going to step in. If we look at the bond market, all right, the bond market is still in our regression channel moving lower, right in this area here, guys. You remember back in 2019, I said let's pick up some puts in TLT. At least I told our members to do this. We were shorting TLT with puts, and it's just been a good trade. All right. Every time we get up near the upper boundary of the regression channel, it's a good place to put on a put because you can set a tight stop if we blow up above it. Okay. So we're still in a down mode in the bond market, which means interest rates are still moving higher. And if we do look at the rates, if we look at the 10-year rate, you can see here, we're same thing, right? We're in this upper bound or lower boundary of the interest rates, but we're moving higher. Okay, so down in this level here would be a place to take a look at if you're not looking at maybe going long TBT or selling TLT, right? So these are just some things that we're looking at for the year. Currencies, well, we had, obviously Friday was a down day. So if we look at the Dow, if we look at the dollar, we've had this wide, longer uptrend for the dollar. Really that started back in January 2019. And then as we finish the year, we break the trend. All right. I think the trend for the dollar is going to be sideways to down in 2020 for our members. We'll go into more detail on ways to trade that. Take a look at the yen. The yen also moved up just a little bit, and it broke out of this downtrend here. All right. Big time. And the yen is a place of safety for global risk. And we had this big break, and it just, boom, it just popped right back up. Now, as long as there's a fear premium in the markets, you're going to see the yen outperform relative other currencies. Okay. And there was a couple of other things that we're doing in the currencies that for our members, I'll review with you later. If we look at gold, right? Gold had that big break. We broke out of the regression channel. Remember, I told you that if it breaks out and then we moved up here, it's clearly a nice trade opportunity. Now we're long silver, but you can see this right here could set up for a cup and saucer pattern like that. Typically, when you break this area here, it'll move up on average another 10%. So that would be another 150 points. Okay, taking us up to about 1800 and challenging the highs that were made here in September of this past year. So this was where I had also said this was the key trade going long. And we chose silver versus gold because silver on a relative basis outperformed gold. Okay. So now we're going to see gold kind of play a little bit of a catch up here on the trade. So if we look at silver, you can see silver also broke out, not as strong as gold, but it has broken out off these lows here, 1659. It's sitting at 18 right now. We're long silver, and I'm going to play this one probably more so than gold. Although another way to trade it is going to be with gold miners. Okay, so gold miners is another way to play gold. Also, there's some other trades in the metals market, and the precious metals that I've talked to our members about that have just been, 56, 60% returns for us. We're going to take a look at those. They'll be key for 2020 as well. So these are just some of the ones that I like and our members I've been talking about, and we've had an opportunity to make some really good money on. Again, if you're not a member, I highly encourage you to come in. Just one of our trades, and you got yourself taken care of for the year, or for years, actually. Let's look at palladium here. Palladium is another one I've talked to you guys about many, many, many times. Okay, this sucker's setting up for another great trade. Members, I'll review it for you on this Sunday evening. For you guys that may not recall, we took one other trade in this on a similar setup, and we had members making $25,000 to $28,000 per contract in a 5-day period. So let's see how this setup plays itself out. Okay, oil. It's all about the risk premium. Right now, you can see the regression channel. We've moved outside the regression channel to the upside. And you'd hear me saying that in the low 60s, I'd be willing to short, but not right now, not with the risk premium on, and we've got no divergences here. So I think oil, the least area of resistance is sideways to up. Okay. If we could fall back into this regression channel, but unless you can also see if we fall back in, I would be more willing to go long at this point in time, short term. You can also see the 50 and the 200 crossing back up again. That's a bullish sign. Also, markets tend to find these areas of cross, come back and touch them, and then move in the opposite direction. So that would suggest to move back down here and then back up again. So these are just some of the things that I see in the markets here that could be really interesting for us as we go through this year. A lot of things in nat gas and that we'll talk about for our members on Sunday evening. Same thing with agriculture, meats, and some things coming up in softs. There's, in addition to all these, there's some really good stock opportunities, asset class opportunities that we'll discuss in our 2020 roundup for our members this Sunday evening. Again, if you're not a member, I highly encourage you to come in and sign up with us. All right, everybody, have a great weekend. I'm back off of my 1.5, 2-week takeoff at the end of the year. I'll see you guys next Sunday. Your non-members, I'll see you next Sunday or this next weekend for this next weekly roundup. Members, I'll see you this Sunday evening. Have a good one, everybody. Ciao.